I would like to make a short presentation of our guest today. So Jacques Baczynski, he's a friend and a colleague. We met many years ago, probably early 2000, and since then we keep in touch. I would like to say that Jacques is a big friend of Israel, and he actually was accepted as an honorary member of Hebrew University this year, of which he is very proud, as I know, and we are proud too, of course. So Jacques works at LNCC, that's the National Lab for Scientific Computations in Petropolis. In fact, I was aware of the group in control theory well before we met with Jacques. The group was very strong, used to be strong, probably strong until today. I just don't know. I stopped working in control, so I'm not really following things. But back then, I remember that it had also deep connections with the Tel Aviv University, with Uri Shaked, as I mentioned. And they did a very nice work in H-infinity control, as I can remember. Marcelo, Fragoza, and Carlos de Souza, and yes, Jacques, and all the team.
Carlos retired.
Yeah, okay. Yeah, that was already quite some time ago. So Jacques' expertise is in stochastic control, and he contributed several important papers in the control of systems with jumps. That was his main area until a decade ago, I think, when he switched to finance, and since then he's active in finance, stochastic finance. And today he's going to tell us, to give us a kind of, as he put it, a soft introduction to derivatives pricings. This is something that Jacques does, and of course, always towards some possible collaborations. So the title is Fundamentals of Pricing and Hedging Derivatives in Financial Markets, and we're happy to have you. Please.
Okay. Thank you very much, Pavel. We'll start then. And about collaborations, I'll mention two guys that are with us here, not here because of the time, and I'll introduce you them afterwards, okay? So this talk is for, as I put in the summary, in the abstract, is for people not acquainted to finance, no? So it's not a case of Jan Dolinsky. Anyway, so the thing is to motivate people if someone is still floating without knowing where to go. So this is let's say, a way to go. Okay, so let me get this thing. Okay. We can put it like this, the problem of pricing the hedging derivatives. You have this is the curve of the stock price, okay? It's random, and it goes forever. And then you have something called a derivative, which is just a function of the whole trajectory of the price of the stock, which is the underlying, okay? Or maybe it's just a function of the terminal time of the underlying of the stock, okay? It's up to you. It's up to the derivative. So the derivative has one characteristic. It ends at T, at big T. It expires, okay? Which is not a case of V, of the underlying, okay? It expires and then thing is ended. So this is a payoff. You don't know what will happen, okay? And the second thing, beside derivative, you have a business. You can, the business happen here at T, okay? There what is happen, it happens. And there's a buyer and a seller, okay? To make a business on this derivative V, okay? So they have a problem. They must set a price, establish a price for this, okay? So that's the first problem, how to put a price in something that you don't know that what will happen at the end, okay? And they make, but anyway, they made a contract. The contract is the buyer buys the derivative. He pays to the seller. It's called the hedger too. He pays to the seller. He's the holder, will be the holder of the derivative. He pays to the seller cash at time T. So it's called the spot price. Spot price. He pays immediately, okay? They made a contract. The seller doesn't handle nothing to him, only they receive his money. And he has the obligation to honor his debt, his liability, at the end. He must honor this, okay? So when the payoff converts into money at big T, he must give this money to the buyer. He doesn't have the money. He has the obligation to, he must, or perhaps he has, but he simply has the obligation to honor the payoff of the derivative. What happened here, he has to pay. Okay, so this is the problem. This is the problem. It would end here if the seller actually is not a gambler. The seller is not a gambler, okay? What he's supposed to do is to honor the obligation. And just to have a feeling of this, the derivative oscillates much more typically as the stock, the underlying oscillates much more. So in the other side, the guy is not the seller is not a gambler. So you must make a fit between this thing that he's not a gambler and the risk uncertainty involved in the derivative. So for this appears the hedging. So the name is pricing and hedging. The seller must hedge his position. He must protect himself against risks. Okay? He's a professional. He's not in the casino. So he must hedge and he will make his money normally. Okay? But not because he's gambling with this. So you have a pricing, is a business here, and then the seller must hedge his position so he can handle he can reduce his risk at the end. Okay, so that's the problem of pricing and hedging derivatives in financial markets. Okay, so more or less this is what I said. We talked about price. Okay, so in this market, a basic thing as the price is called no-arbitrage price, okay? Which essentially means that equivalent products, those that produces almost surely the same payoff, must have a unique price. So it's an assumption of our model, and in practice, it's something natural in the market. It's natural. You cannot sell two things at different prices. If you begin to sell two things in different prices, pressures of selling and buying, after one time will level the two prices and will then be the same price again. So this stable price actually is this no arbitrage price. So everything fits in practice and in theory, okay? So this is a mathematical visualization of what would be arbitrage. No? It's something that you start with zero, and after one time, there's no losses for sure, because your final portfolio, say, is positive, it's almost sure, you don't lose, okay? And beside this, you have a positive probability to earn money. So something is wrong in this sense, because you are making a profit starting with zero, okay? So the framework is, so we must put this practical thing in a framework, to stochastic framework, because if not, you don't know what will happen. And if you even don't have a probability set, you can do nothing. No? I forgot things here. You have another guy here, which is a complementary, it's a money market account. So it stands for having a reference of inflation, say, or risk. It's a risk-free asset. So it's very, very low return. It's positive. If not positive, something very wrong is happening. I mean, it's increasing, it's not decreasing, okay? So just to complement this. So we set a probability with right continuous filtration, okay? And we have the underlying S and this risk-free. It's a risky asset, and the risk-free asset just have to be square integrable, adapted to the filtration and Cadillac, okay? For those who are not acquainted, this is it's in French, continue à droite, limite à gauche, it's continuous from the right. And so we go on. Here is a landmark result of the valuation on the valuation contingent claims, which is the derivative. And it says that if your derivative, your payoff, is FT measurable, okay? It's the same thing I put in the argument, the trajectory of the stock. This is a more general probability framework. It means the same thing, okay? It's measured at T, big T, and we suppose it can be replicated by a portfolio of a self-financing strategy. Okay, this is exactly what this is, a hedging thing, and we'll leave it to ahead. So we have a no arbitrage price here, which was his result. It's very naive, because if you don't know what is something is the V, now you take the average. And this thing here is just because the buyer is buying, he's paying at spots. It's a spot price he pays at T, and he will only receive at the end. So this is an advantage for the seller. So to make a compensation, you reduce the value exactly by this curve, which is the inflation and the risk-free asset, okay? So it was very intuitive, okay? But the point is that this Q is not the real probability, but is so-called Martingale probability. So This we will see a glimpse of key, goes like this. You suppose that V is the terminal value of the underlying cells. It's a very, very particular case, but it's still a derivative. No? So if you just, wait a minute. Yeah. Okay. If we just put it in the discounted values, which is defined here, okay, we're putting everything in the, it's like a numeraire. Yeah? You put everything in, instead of dollars, you put in the reference of the risk-free assets. So you make everything flat, which in practice is very interesting. You can compare $1 amount of your unit, monetary unit in January to December. This doesn't make no difference because inflation doesn't count, okay? So you have the discounted value. So you start up, you go from this equation to this equation here, okay? The same thing, just make this B from here, just a simple manipulation. And we have that the S bar, which is the discounted price of the underlying, okay, is the average of S bar given FT, which this is the face of the Martingale process. So what is the Q? The key thing here, Q is under Q, all discounted prices process of all underlyings. We have only one here, but must be Martingales. Okay, so this is the big thing. The key is such that all prices should become Martingale. So the framework is a Martingale framework, which is interesting in practice because if it's not, you should have a glimpse of what would happen in the future. Because suppose it's a sub-Martingale. Yeah? Sub-Martingale, which means that this thing here is bigger than this. So this will give you a glimpse that the thing will go up, the prices will go up. So a Martingale setup doesn't say anything. Just say to you that the average in the future, this is exactly what you have now. So you don't have nothing to do. There's no hint for you. You don't have nothing to do. So this is good because this got things fair. There's no bias, okay? That's it. So taking the benefit from this formula, what we were motivated, because it's an expectation. You don't need to be in probability in finance. This is an expectation, conditional expectation, just that, general, abstract. So our work is to make this thing here, a method to develop this. I won't lose time in this because time is running. But the main feature here is that all EDP's methods, you find the price directly. The EDP is connected to the price. That's what the PD, the partial differential equation, seeks prices. That's what they do. We're not doing this. Our PDs seeks probabilities and then prices. So this is new in terms of concept, okay? So let's go on. So what's a hedging strategy? The goal is to replicate or else to match or hedge almost surely the derivatives payoff via its associated portfolio value process. So this is a strategy that continues to control over time the investment in the money market account and in the underlying assets. You just swapped one from the other, okay, and try to replicate the end. This thing constitutes your portfolio, and it must involve additional cash inflows in the portfolio or withdrawals. or each in time during this little t up to the expiration time. You handle. This is a strategy, okay? Hedging is a strategy to protect you and to finally get the same thing at the end. When you get the same thing, it's almost sure, okay? Almost sure. It's not in the average. You replicate exactly. That's the aim. Self-finance strategy is a strategy, but it does not involve additional cash in the portfolio or you withdraw, okay? So it's nice. Think it would be what people search all the time because you just start with an amount of money and you let it go. You make all these swaps, but you don't interfere anymore, okay? So it's much better. That's the hedging, and that's how the guys protect the seller is protecting himself, okay? Okay, so the spark replication doesn't exist, in fact, because trading are discrete in time. Discrete strategies are still a strategy, but they're not, let's say, perfect, okay? So you have an error, and you have transactions cost involved, and of course, model is a model, okay? You cannot look for everything, okay? So you have a hedging error will eventually occur. So you want to replicate exactly. So you have an error, which is a random variable, and has a standard deviation, etc. So because of this is another article we are making. This is an old thing we published 10 years ago in the Risk, which is a very important magazine. It's not a normal journal, okay? But it went to the cutting edge section and they put a figure, so it's very, very nice for us because they are top people that publish there. So that's what the motivation we made it. And exactly was a thing to measure errors, hedging errors, okay? So now come back to I want to close this thing. Okay. So going back to our subject matter here. So you consider our framework here, which has the underlying price, discounted underlying price, which is a Martingale now because it's Q, okay? And there's this big characteristic, which is a Martingale, square integral, etc. Okay, and the price of the risky assets. See, like another thing, we divided for B, then B divided by B is the B. It's 1, so it's nice because it turns things easier. The process is the number 1, almost sure. Okay. All in the discounted framework. That's in practice and theoretically the best thing to do. So you have a general hedging strategies here. Well, phi describes the number of units of the risky asset, and eta describes the number of units of the risk-free asset, name it like that, okay, which is the money market account. Okay, this data here, you can think, or you think of the money market account because B is 1, okay? You start normally with some value and it goes, but in this count, this is 1, so it's all the thing. So now we come to the point, mostly how hedging can go on. In general, hedging is not a self-financing perfect thing. So we try to minimize things. So this work goes towards this kind of thing, okay? So phi is adapted to write continuous, must be a predictable process. Okay, so even though with a CAG lag, not CAG lag, continue à gauche. And it's a square integral. And the eta is the thing with the risk-free asset is adapted to F as well. So we have, this is the portfolio strategy. You have V, which is the amount of assets you have of S, the price S, and again, the amount of one with himself. So this is a portfolio in the discounted unit of monetary units, dollars, divided by dollars, it doesn't matter. But so you have a portfolio here, okay? And you can put it in this way here, okay? Because just V is by 0, by O, and into this is standard for any type of equation. Yes? I'm just putting like this, and just to put the V using this 10 here, okay? So this is a Ito integral, okay? D and D, okay? Normal. Okay, and we start with V0, which is, I think, was F0 measurable. Some authors put this in deterministic, but better not. And now, in the self-financial scenario, this is what happens with this equation, because this is general. If this both guys changes, okay, you can change this however you want, because you can put money or take money. So let's say in practice, and the portfolio goes like this. But if it's self-financing, you don't put money, the thing only varies because of the variation of the asset itself, of the underlying S, okay? In the discounted thing, it should vary also with the risk-free asset, but it's one, no variation will occur. Okay, but anyway, it will vary with the discounted guy and with S. That's what self-financing means. Okay, so the portfolio actually must equal this thing. This thing is fixed, a DT occurs, and only the variation it has impact. Again here, T from dt occurs, but you stick with N, eta S, and just the variation of one is taken into account. Variation of one, it's 0, it will disappear. But anyway, okay? So the portfolio must make this equality. Okay, so this it's eliminated, we still stand with this. Okay, so it's a self-financing guy portfolio, just evolves in time like this here. Okay, and the only thing you make is the standard capital contribution is done here in the beginning, V0, pa. So, and the rest is just the flotation of the underlying. Imagine that the underlying doesn't varies, stand still, stand without movement. The portfolio will stand as it was in the first, in time 0, just flat. Okay? So this is a self-financial, because you don't put, you don't take. Okay, if it's not self-financial, then this thing will vary, in spite of the fact that this doesn't. Okay, you put things on, so actually the whole thing here will vary. Okay, so back to general strategies. So this guy is an important guy. It's called the accumulated gain process. So you can, because he's the guy who only depends on the market. Okay, so this gain is solely due to the variation of the risky asset. Okay, you call it gain, and you have then the accumulated cost, which is the rest. Okay, is the rest. So the cost is just your portfolio. This bar here is just to say that it's. I could have taken it, should have taken it out. But this is the portfolio minus your gain. Okay. We won't go directly. The strategy is not to go directly in the equations of C. Okay, we just make some. This is a bad thing to see how the cost goes. So the portfolio goes is the cost plus the gain. Okay, you have the cost plus the gain in a general hedging strategies. Okay, so for self-finance strategy, the cost does not depend on T, and it's given then by only the V0 as we saw before. For the okay, here it just depends. Let's see here. Okay, you have V plus this integral, and then you take out the integral. Okay, so we get only the first position here. So the discounted order price of attainable derivatives, what we have. So you have VT, which is Y0 plus this integral here. We are in the self-financial thing. Okay, so let V be the discounted payoff an attainable derivative in a complete market or not. What means attainable? Attainable is because a self-financing strategy can go there, okay? Wait a minute. Can replicate it, okay? We start with a V0, and then you swap between, the eta still exists, okay? It didn't disappear. In the portfolio, it does appear like that, okay? But the eta still exists in the self-financial, even in the self-financial strategy, okay? It just won't appear here, okay? So when you set this guy, eta is then defined also to match this equation, self-financing equation, okay? Okay, so you have an attainable derivative. You then can assume that they're both SF pairs is the one that makes VT equal V, replicating almost sure the derivative. Then by the no-arbitrage argument, this V0 is the discounted price at time zero of the derivative. Again, because why? Because you cannot have two prices for the same thing, okay? So if you start with a zero, you don't put money on it, okay? And it replicates V. He is the price of the, because if you put another price, you have two prices for the same thing. So VT is equal V. Okay, so a self-financing strategy gives you, not as a byproduct, but it gives you the price of the derivative when you're making the business, okay? If you manage to have a self-financing derivative. So this is a proposition of Föllmer and Sondermann with section 2, okay? This thing he did, this work here It's aimed to, we can read it without someone speaking, okay? So someone get interested. So relying the condition for a general strategy as above this stochastic integral. Here is a Martingale. So for a general strategy, so this is very interesting. This guy is handleable, okay, with Cadillac trajectory, null at 0, and square integral, okay? And we can write things like this here. Yeah? This is the quadratic variation process of the underlying, okay? So we say that the strategy is square integral under the underlying S discount. Huh? Here, perhaps this is time, I don't know. This is a thing from Kontankov. This is a nice book to read for applied to finance, mostly Levy process. So this gives the same result of proposition here for Formel-Sonde that say this guy is a Martingale. So here's the result here. So he picks a strategy which has this form. I won't go into this, but this is a discrete time. So it's implementable, as he said, because you cannot make swaps continuously in the strategy, which would be the ideal thing. In practice, you make from time to time, you make your swap from money market to the stock, etc. And so that's what he's saying here. Okay, this guy phi, he's fixed between ti and t minus I, which are swapping times. So it's implementable because of this. This is the implementable thing because you can act discretely. Yeah? That is the point. So when T1 comes, you can change this quantity phi for another number. Okay, so it goes. So this is a strategy. Probably it won't get in the derivative that you want. Huh? But it will go to a derivative anyway. Okay, so this is he holds it up, and he proves that then the gain associated to this strategies described like this is a Martingale. Okay, this is actually it's not realistic because you cannot work in practice with stopping times that easily. But if you make the T's constant, it will still be stopping time. And then it's a real thing because establish the times when you will make your balance, your rebalance, okay? So here is a thing that just to say that the predictable quality of the Föllmer-Sondermann setup here is important. Without it, you will lose the property of having the gain a Martingale. It won't be a Martingale anymore. And as I said before in the beginning, if it's a submartingale, then G is submartingale, then V can be also a submartingale, and then you have chances to arbitrage, because you'll have this property that the final thing is more than you have now. So you start buying things, probably. It's not sure, almost sure, but it's in terms of average, it's not good anyway. And so this is just to show this. So to define better that, but so okay, sorry. So now we go to this. Wait a minute, because the thing went. Okay. we go to strategies to reach non-attainable derivative. I should explain better. No? A self-financing strategy reach some derivative. It replicates the derivative. So this guy is attainable by a self-finance strategy, which is the bad thing. Okay? But in most cases, most derivatives, they don't have us. You can find a self-finance strategy that will replicate it. So we must solve this problem somewhere, some way. So you have to reach non-attainable derivatives. So how you do it? You want to reach them, but you can minimize your risk. You can minimize your problems with this. So two ways to doing this. We will address only the first one because there's no time. So you must insist on replication. We may insist departing from the nice class of the self-financing strategies. Okay? So you don't put money. The second thing, you give up replication and stay in the class of self-finance strategy. So you won't replicate. You try to minimize some errors, like the paper we were doing now. You have some hedging error. Okay, but here you insist in replication. I think this is a more sophisticated method, but you insist in replication to depart from the class of self-financing strategy. So departing for it, you can reach easily the derivative. Then we should identify strategy with small cost in some sense, in terms of injecting or extracting money from the strategy portfolio. Okay, so we go into this. So Föllmer was the man who originally set this thing, and we shall describe IT1 above. Okay, this is Holdenson, and Schweitzer also did this work, implemented, extended it. Okay, they address in this case what they call the mean self-financing strategies. Okay, mean self-financing in the class of general strategy are those where the cost is a martingale. So that's the thing. He imposes the cost to be a martingale. Okay, so a self-finance strategy is mean self-strategy, is mean self-financing, because the cost is the V0 itself. Okay, so that's how he goes. So the first thing is he puts handle to put everything in the Martingale framework. So strategy means self-financing if and only if its portfolio value process is a square integral Martingale. Okay. So he put the portfolio into a Martingale framework also. Okay. So let us fix a derivative is starting at t with a discounted payoff v, ft measurable. Okay. And let's pick the class of all means SF, mean self-finance strategy, that replicates V. Okay. So you're departing from the self-financing, and you go to a broader class. We call such class admissible with respect to V. Okay. So this just to show that the main, whatever the strategy is, the mean value of the cost is the same for everybody, for every strategy. Okay, this is important because everybody wants the cost to be lower. If it would be not, I don't know if you could go on with this theory. So this is a precondition that occurs, which is nice. This rollouts using ST as a minimization criterion, perhaps. Okay. So for all admissible strategies go up to V, you have this thing here. What Föllmer did was he push this thing, he defined this thing here, which, as you can feel, that is he's worried with the variance, the ripple, the variance of the cost at the final moment. Okay? So you first minimizing through all admissible strategies with respect to V, the cost variance, which is the cost, final cost, minus its mean value, which is the same of V, okay? So this is an interpretation. So the cost you can put as the variation, the ripple, this is the quadratic variation of the cost from 0 to t. See, if you want to minimize this, it's more or less the same as minimizing this, or the same. You have a modulo, a constant that depends on C0. This is not deterministic. So let's focus on this. So this, you want to minimize this ripple. That's something which is interesting. We will see because. Why? Yeah? Let's go directly to this. What will happen here? Well, the criterion penalizes the quadratic cost of C. It searches for an admissible mean self-financing strategy whose cost process is as close as possible to a process with no quadratic variation you're trying to minimize. Okay, a constant process. So, and who has the constant process? The self-financing strategy. It's flat, the cost is flat because you don't put or take money. The cost happens the first time and then it stays flat, which means nothing is happening exogenous, okay? So what you're doing actually, you are trying to be near self-financing strategies, trying to make this quadratic cost very low. Okay, so Schweitzer said that risk minimization is a hedging approach designed to control the riskiness of a strategy as measured by its cost fluctuations, okay, which is exactly this here. So then we go in where we have 10 minutes, we won't get to the part 2, I think, I wonder, but it's more or less the same. This is a very nice framework because you are in the orthogonal world, both in process and in the random variables. So let's denote here the space of all square integral martingales with respect to FQ, okay, null at 0. Okay, so the process in though with the inner product, we are martingales here. So we can define it in the random variable space with the terminal guy here. And let's set I2 a closed linear substate of this martingale space here. Okay, denotes itself, denotes the set of all stochastic integrals with respect to S defined on 0t. Okay, so imagine you have a subspace inside here that are those integrals confined to those strategies here we defined earlier. Okay. So this would be the terminal point. You have a random variable. Okay, terminating at 2. And let's consider N, a more strong interval in Martingale, which is said strongly orthogonal to this space of a stochastic integral. If N times this guy, this is standard from Prof, etc. The multiplication of this process is again a Martingale. And orthogonality also follows, okay, like this, random variables here, because they are Martingale, okay? So let V be a random variable representing the discounted payoff of the contingent claim, okay? Now we have a derivative, okay? So we rely on the Galtchouk-Kunita-Watanabe decomposition. You have, let's forget the strategies for what would be a strategy, but you have your spaces, and there's a unique strategies, okay, and therefore a unique stochastic integral, and a unique process and strongly orthogonal to this space set up by those stochastic integral with the strategies. And you can decompose this V minus this initial point here. You can decompose it in a guy where of this space, and we are here in the set of random variables, okay? So in terminal, from 0 t, you get in the terminal in the set of this guy, you have nt here, and nt just stems from the orthogonal process. Orthogonal is the field of this stochastic integrals. Okay, so you can choose those guys here, and the final, a special guy, né? Here, it's not anyone, it's a special guy, and the terminal setup here, plus the terminal guy from N, they make V, replicate V in an orthogonal way. And orthogonality, we know, anyways, always gives us the minimum distance, etc. Okay? So concerning the space of random variables here, this guy is the orthogonal projection of V, and NT is the error, okay? Orthogonal to the space of those strategies. Okay, so Föllmer's theorem is that an admissible strategy minimizes our criteria, which is this, throughout all the admissible strategies or all admissible stochastic integral, if and only if the strategy is the one that solves the Kunita-Watanabe decomposition. Okay, this was a very nice thing. So moreover, the minimum is given as expected by the expected value, which is the norm of this NT. Okay, so you have a minimum distance, okay? As in the Euclidean space, everything is the same. Okay, so the particular case of an admissible SF strategy, you attain V through someone who is in the space here, because it's self-financing. Self-financing, you pick one that goes up to, because it's attainable, okay? So V is achieved by this. And if we compare with 29, where is he? Which is the Kunita thing. You can, it's here with, so you can see the V is, which is this one, it gives us that, okay, it's here. You compare these two things and you have that this V is here, VV is the Kunita guy, and NT is 0. So you are in the space, you are inside the space modular constant. Okay, and this 5 minutes. So what he did now was, yeah, that's very important. Where is it? Wait a minute. I don't know what it went, but the thing, see, you define this guy, wait a minute. Here. in the general case, in the general case, this guy is uniquely solved, and the other guy, don't forget, he always exists, is immediately determined in the self-finite framework. Okay, here not. But what happens, this guy is any process that handles the self-strategy admissible in the final point. So the only what is determined is the final in big T. The rest of it is totally a free adapted process, totally arbitrary. Okay, so you don't have a unique solution. You have a unique guy here, but this guy is free. Okay, this is the first approach. That the thing is exactly that. Föllmer succeeded in sharpening the cost covariance criteria. So he defines something more interesting. Instead of focusing only in the endpoint of the cost, he engendered this thing of risk measure, which is the final cost man and the cost in the present time. So this goes through time. Okay, it changes. At each time you have a cost here. Okay, so this was what was make him able to make a unique solution for the pair, for both pairs. So the advantage again is the same. You have this ripple being slowed down for each. This is not more a number as before. This is a stochastic process, but if you fix T, you have a random variable. If you take the med, then you have a number, and still not, because you have a conditional random variable. Okay, so it's richer. So, well, 2 minutes. I don't know. I have my clock here. I don't know how much time I have.
Sorry, I think 4 more minutes.
Yeah.
Yeah.
Okay. I didn't ask. Everybody's listening, I hope.
Yeah.
Good. Wait a minute. Okay. I lost myself. Where I am. Okay, so we penalize again this cost, but this is conditional. Now conditional probability expectance. Okay, so definitions and comments about this is a strategy. Well, this is the interesting thing, because how to minimize such a thing here? How to minimize? This is a risk measure, okay? But a strategy, he defines a strategy that is a continuation of a certain phi hat here if the past from T is the same, okay? The set of continuation decreases as T approaches T, okay, and reduces to it this hat itself at the terminal time, okay? So you have subsets of strategies. So a strategy is called risk minimizing with respect to V if it minimizes the remaining risk in that for each T, that's the whole thing, for each T, this guy is less than this for each T, okay? Key almost sure. So as I told, it was not a number, okay? You fix T, but still you have a random variable. So how to compare to random variable? It's not in the real line. So he succeeded to manage a nice thing because it happened almost sure. So it happened almost sure. So this is how things really work. It's not an assumption. It's what he defines the guy to be the minimum. Okay? So then tracking the claim, so you define the square. So instead of having a V, you have, which in the attainable case, you can recognize here in the Pliska result, the price of the derivative, which is not the case here because this guy is not attainable. Okay, but he defines this PV here. Okay. And then again, the nice thing of orthogonality, he uses the Kunita-Watanabe, and the thing repeats. And again, you obtain, then this is the same of the process is the same as before, because the definition of the spaces didn't change. Okay, so you have this guy as before, the associated portfolio is this, and as the portfolio is this, now you define a portfolio associated with this, the system, the method gives you this guy here. So you, through this, you define who eta is, because eta is such that VVT minus the risky part is the risk-free part of the thing. So eta is defined. So you have a unique solution really for the pair. That was his big thing. And then again, you have orthogonality and the error. I didn't got, it's not my daily research thing here. So I had some doubts here, which I leave. This, as I told, was meant to people that are interested starting in the thing here. So we have some doubts here about this Kunita-Watanabe, because he said that orthogonality is not with everyone, but only with S, okay? With S. The N is orthogonal to S. So there's a doubt here about to end this method here. Anyway, so thank you very much. This was must. Yeah, let's return here.
Pavel, do you have anything? Oh,
in fact, I have a small question regarding Galtchouk-Kunita-Watanabe. Can you hear me, Jacques?
No, something got.
No?
Wait a minute.
Can you hear us?
Yes, sure.
Can you see us?
I don't. Well, anyway, I can hear you. That's
okay.
Good.
So if I understand correctly, the Galtchouk-Kunita-Watanabe is actually the generalization of the classical Ito representation theory, right? In some more complicated situation. Now, even in the Ito case, finding this decomposition explicitly is quite a tricky thing, and it doesn't go really beyond some very special examples. Even though there is this Clark or Cohn formula based on the Malavin calculus, but here it seems that it's even much more complicated, isn't it?
Well, how I said this, I'm not talking about my research. The three things, so this is, I cannot say much about this. I cannot say. I just make this framework to give motivation for the people, because this is backbone, I think, from this hedging and pricing thing. So I cannot figure out if it's more complicated or not. This is a 1986 paper from Sondermann and Schweitzer. Then he did it into one. He extended to semi-martingales, the whole stuff, which is not Ito anymore, I presume. But
I see. Okay.
yeah, but he uses the Kunita-Watanabe equation. He uses it, and that's what I can really say about this. I know you, Pavel, I was expert in Kunita-Watanabe.
No, not at all.
No.
Not at all. I just know that it's complicated. I don't touch it.
Yeah, you know, I don't master this.
Thanks. Thank you.
Yeah.
Okay, thank you very much, Jack, and for giving a talk in such a early hour, and it was very interesting. So thank you, thanks again.
Okay, let me tell you one thing. Just I had there were two people here that because they're not here, but they would be interested if they are very receptive to make contact with the university. Okay, one of them is my ex-student of PhD. He did the PhD. Now he's in the LNCC, and he's a finance guy. He's not a mathematician. He comes from finance, but he's a clever guy, and he's working with this stuff, finance. His Alan is called Alan Jonathan, and he's a younger guy. And the other one is a mid-aged guy. It's called Todorov. He works with control. He's the early stuff I was in the previous time, first part of my academic period. So this control, he needs control. He's very receptive to work. I can then give you their contacts, and that's it. There was no time to show anymore. Yeah. Okay. Unfortunately, I cannot put the screen. Wait a minute. Now, what? Finally, wait a minute. Yeah. Now I see people. Okay. So thank you.
Thank you very much, Jack.
Yeah.
Thank you very much.
All right.
Talk to you offline. Bye-bye.
Bye.